Welcome back. This is Patrick Padalato, and I wanted to continue our series by focusing a little bit on some general terms that we're going to see in accounting, starting with arguably one of the most important things we're going to spend some time on, which is the financial statements. And so, first set of terms, I just want to talk about terms that relate to the financial statements themselves. And each company is required, if they're filing a publicly traded company filing under US GAAP, to create at least annual reports, which is the once a year set of information that can be actually quite long and extensive. And it does include the financial statements that I have below, in addition to a series of other information, additional details about performance, management's commentary on their performance, footnotes that provide detail that flesh out the financial statements. And so these annual reports are very extensive. And actually, once you get some exposure to working with them, because they are a little bit challenging to use at first, but once you get exposure to looking at them, can be exceptionally valuable sources of information. The requirement is at least once a year. Companies are filing those with the SEC, the Securities and Exchange Commission, and making them available to the public. But for many companies, most large companies that are publicly traded, they're also going to be doing this on a quarterly basis. And the quarterly report called a 10K, where the annual report's called the quarterly report's called a 10Q, the annual report's called a 10K. You don't need to memorize those terms, but they are what accountants and others using them refer to. The quarterly report has less information, but is a more frequent update in what's going on. And it is actually each quarter, so 4 times a year, although the last quarter is usually just included as a part of that final annual report. So we're getting those check-in points from the company released to the public so the public can use them during the each year. Included in those, and arguably one of the most important pieces, but I don't want to say the only important piece, would be the requirement for a set of financial statements. I'm going to focus on these financial statements for the entirety of this series. There are actually others that I will quickly refer to, but not spend extensive time on them. The income statement first and foremost, and I'll describe that in more detail, all of these on the next page, which is commonly referred to as the profit and loss or P&L statement. Just that's the vernacular. Get comfortable with it. When people say P&L, they don't mean financial statements in general. They mean the income statement. The balance sheet, which we'll show a little bit more on, also called a statement of position, or some people refer to as, companies' financial statements as their balance sheets. I would technically not recommend using that term. The financial statements are a series of these: the income statement, the balance sheet, and the statement of cash flows. Those are the 3 most important ones when it comes to analysis, valuation, looking at what's going on. I would absolutely recommend understanding each of those, and we will, and spending my time there. But there are others, and to quickly mention them, but if you're specifically in a reporting role, you do have to understand all of these, but if you're not in a specific reporting role, you really still want to spend your time on. The general business person should really understand the income statement, the balance sheet, the statement of cash flows. The others, just be aware that they're there. They include statement of stockholders' equity, statement of comprehensive income. So there are a little bit more, but I want to de-emphasize those relative to these big 3 that I want to cover. So let's get into these in a little bit more detail. What I have here is just a way of talking about some of the terms that we see specifically on financial statements. And I actually want to start with the balance sheet because it contains what we refer to as the accounting equation. Assets equal my liabilities plus equity. And I drew that picture because it has to be this way so that the assets do exactly equal in terms of the sizes of the boxes or the rectangles, but also in terms of numbers here. Assets equal liabilities plus equity. I'll do a much deeper dive working through a couple companies' balance sheets to show you exactly what happens here, going through some of the terms of things, but let's cover these 3 main elements first and foremost. So first, the balance sheet shows what we have at a moment in time. It's a snapshot statement giving us the things that we have, assets, liabilities, and equity at a moment in time. So what are assets? Assets are not necessarily things that we own, but they are things that we have and things which are expected to give us future economic benefits, right, that we have rights to. So generally speaking, you can think of things that we own, but I would say not necessarily do we need that condition. Things that we have access to, things we control the future benefits of. Liabilities, on the other hand, are what we owe to others. We could owe them to suppliers. We could owe them to employees. We could owe them to people who've provided us with debt. And then equity is the portion of the business that but the we here is actually our shareholders, that the shareholders own. And that's what's reflected on the balance sheet. We will absolutely do a deeper dive into the specific line items and specific companies, but I wanted to introduce that general idea there. With that being said, I think it's valuable to actually to discuss how the balance sheet can be represented in a similar fashion to the general idea of home ownership. Right? So let's go through that. In home ownership, you'd have your asset would be the home itself. And this works well because while we control the benefits of the home and certainly enjoy that, we don't technically own it outright. And one reason for that is that most homeowners have a mortgage attached to it. So the mortgage would be the amount we owe to the bank. That would be our liability. And hopefully you're in a situation where you do have some partial ownership, whether that was the payments you made over time or the amount you put down, et cetera. So the ownership portion, which we do, fortunately, it's why I'm using it, called equity, would be the portion that we, the homeowner, owns. And so who owns the home then? Well, you'd really say if you have a mortgage, it's the bank and the homeowner, both do. The equity portion is the amount that the homeowner owns. And the liability that remains, the mortgage, is the portion that the bank technically owns. So assets are what we have access to, and we have liabilities and equity. I'm going to go on to the second statement. There's a lot more we could talk about all of these, but to keep it somewhat brief at just the introductory level, we have our income statement. Our income statement reflects our revenue, which is what we earn during a period. We remove from that, in a simplified income statement as I have here, our operating expenses, which are what we incur during the period. The expenses represent resources used up, cost incurred. And those two combined give us operating income, which is a useful metric that we'll cover in additional lessons that gets at how much money did we make from our core operations. That's a good lens to kind of look at core profitability. After that, we would look at a series of other expenses, gains and losses. These can include a variety of gains and losses. These can include taxes, interest income, et cetera, interest expense, interest income. So we have other things. And the reason for segregating that out is that those are not related to our core business, but they're still expenses, gains, or losses that happen. All of that combined, which is revenue minus all of my expenses, gains, and losses, would give rise to bottom line net income. So my revenue is my top line. My bottom line is net income. Net income is after every expense, gain, or loss in that period. The income statement, unlike the balance sheet, is not actually specific to a moment in time. It's for a period of time. So it could be for like a fiscal year, or it could be for a month, or it could be for a quarter. That means the revenue is earned during that period. So if it's, fiscal year 2023, revenue is earned during that entire year. If it's the month of August, it's the revenue earned and then all of the expenses for that period. Which brings us to the last statement I want to talk about, the statement of cash flows. That's where we translate our business activities. So technically, our business activities are reflected on the balance sheet and the income statement. That's front and center with what we're doing with those. But we also want to translate those business activities to the statement of cash flows to give a little bit more detail about the inflows and outflows of cash. And we will absolutely cover this one in more detail in the future as well. I just wanted to start with some general idea of what we have here. So there are three sections. It's the cash from operations, which I'm actually going to relabel cash from day-to-day operations because that's really what it is. And then we have the cash from investing activities, but I want to relabel that as cash from longer-term investments, the second section. And then we have cash from financing activities. But again, I've taken the liberty of relabeling that to cash flows from external financing. The reason why I have those three relabeled is what I've done here at the intro level is just get the heart of what's in each of them. This is a really challenging statement. In my years of teaching this across all groups, I think the hardest one by far for students to master is the statement of cash flows. It gives the appearance of simplicity, but it's really challenging. And one of the ways to start that process to get better at this really complex area is just to think about what goes in each of these sections. So I've relabeled the sections as a general starting point there. What's the point of the statement of cash flows? Like the income statement, it's the cash inflows and outflows over a period of time. it's going to flesh out specific, either in the section or by the line item, and we'll work on this, specific inflows and outflows of cash. So which of these statements is important? Absolutely all of them. They really are designed to work as a system, not designed to be standalone. So we might have a limited perspective, and I would caution against ever making decisions if we only have one of these statements as opposed to at least these three and possibly other information as well. We use the financial statements on their own to do assessments. We can also construct ratios or metrics from the financial statements. So a lot of analysis, valuation, forecasting, et cetera, is actually built off of using the information on the financial statements. And we'll definitely do a deeper dive into these so we get a better understanding. But I wanted to start us off our three financial statements. We have the balance sheet, which has the accounting equation, assets equal liabilities plus equity. We have our income statement, which has revenue minus our expenses, gives us net income. And then we have the statement of cash flows, which categorizes cash flows into cash from operations, cash from investing activities, and cash from financing activities. And that set of three financial statements is a really, really important starting point for users of accounting information. Those of us who have to make decisions with financial information want to be very, very, very comfortable with the financial statements and related information. But for now, let's move on. We've got more to cover here. I just wanted to highlight a few terms, some that I might mention, and just to kind of make sure we're clear on that going forward. So generally speaking, with financial accounting, we're talking about publicly traded companies, which are just companies that have used public markets to have their shares available basically to individual investors or larger institutional funds, et cetera. And I'm using Walmart here, hoping you're familiar with the company. But you could at any point, this is not a recommendation, but yes, any individual when the markets are open could go and buy Walmart stock. What I have there is the close of the last day when I recorded this slide. That's their stock price. At any point in time, this is going to change. But the stock price itself closed at $161.57. It was down that day, but I wouldn't take too much information into slight tweaks in company performance. It's actually up considerably during this year as a general idea. That's just one day. But that is the fact that Walmart is a publicly traded company and it has issued stock, which means individual investors can buy or sell Walmart stock. So those of us who buy shares in a company, we're referred to as the shareholders. And more formally, we could say like we're the providers of equity capital. Companies don't have to be publicly traded to have shares. You can have companies that are private and have equity holders as well, just to be inclusive there. Walmart is absolutely a publicly traded company and has been so for decades. I don't remember their exact date that they went public with their IPO, but it was quite some time ago. So what can we do with that? Well, one thing we could look at is like the company's value of all the shares outstanding is referred to as the market capitalization or the market cap. Walmart's at that moment in time is roughly $435 billion. And again, that can change as the share price changes. And what is that specifically based on? The share price times the number of shares outstanding. It's not necessarily the total company value, but it's a good starting point for it. It's the value with respect to all of the shares outstanding at a moment in time. So that's what we have for Walmart. The reason why it may not actually be the total company value is you can also have other individuals who've invested in a company, lenders or providers of debt capital. So a bank or a financial institution could lend to a company. They're not shareholders. They don't have the same voting rights, et cetera, as an equity provider of equity or someone who owns the shares, but they're still an investor in the company itself in a different way. And so this would give rise to, it's not literally required, but those are bonds. But I wanted to throw that term in here because we commonly talk about investing in stocks and bonds. Investing in a stock would be like buying Walmart, a share of Walmart stock, as I have here. You could also invest in bonds that a company has issued. And both groups, shareholders and providers of debt capital, or people who invest in bonds, are absolute users of financial statements who would benefit greatly from understanding accounting as a lens into what's going on as a business. So a lot more to come on that. Just an introduction of some terms to get us started here. We will definitely do a deeper dive into using this information and some of the decisions that these parties make. So hopefully that was a useful way to get us started with some of the terminology. And we will we'll progress with more stuff shortly. So one more down, 10,000 more to go.